Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 344 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the recent market weakness, financial scams to be aware of, an update on the Mag 7, and a reminder about midterm election year seasonality for stocks. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So Matt, March Madness, bracket update, how are we looking?
Well, my wife's looking very good right now. I have gotten decimated in the second round. It was not a good outcome. But I will admit that UConn-Duke game this past Sunday was absolutely electric in the definition of why you watch college basketball during March Madness.
Right. Yeah, the one we had Mia do a bracket this year, and I would give her the names and show her the mascots. She actually had Iowa going very far this year.
Good,
so that
for
was her
her.
one pick. The rest of it, the bracket didn't look very good, but she had Iowa when a lot of people didn't. But yeah, exciting time. Weather's warming up, so
It is warming up.
Hopefully,
Isn't that nice?
in the transition here in Dayton.
Silver linings.
Yes, for
Green
sure,
shoots.
for sure. As always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from YCharts, and this is going to be as of the market close on March 31st. And just before we get into this, Matt, maybe for some newer listeners that are joining us for the first time, we typically our schedule or our outline of events, we go over the major market indices over the past month and year to date. So
Correct. Each episode.
Things like the S&P 500, the Dow, the Nasdaq, give people an update on performance. Then we go through some big headlines or current events from the past week that we think are pertinent. And then you and me both pick 2 to 3 pieces of research that we found interesting to share with people on the current environment that could be related to stocks, bonds, the economy, could be financial planning related. And then typically we end with a financial planning topic of the week. So if you are new listening to this, this is our typical cadence that we go through, and just wanted to reiterate that for people.
And in our section where we talk about tweets, articles, and research, I think we do a really good job cutting through the noise and really dialing in on some of the narratives in the market that aren't really being talked about. I think we also do a good job being forward-looking. The news flow and the thought process in this market is so short-term. People can't think beyond a week or two. And I think we do a good job bringing that longer-term perspective into the fold.
Yeah, and I'm glad you said that, because I think what we do a good job of is highlighting people that you and I highly respect in our industry, some of which we have relationships that aren't on CNBC 3 or 4 times per week getting most of the media attention, where, listeners of this podcast might not be familiar with the people we're mentioning, but we are mentioning them so often here because their work is phenomenal, right? And we think that more people should be aware of their stuff.
Well said.
Getting back to pricing, like I said, this is going to this data is from YCharts, and as of the market close on March 31st, so through the first quarter of the year.
Okay.
S&P 500 index down 5.1% for the month of March and down 4.6% in the first quarter. Dow Jones Industrial Average down 5.4% for the month, down 3.6% for the year. Nasdaq Composite Index down 4.8% for the month and down 7.1% for the year. The Russell 2000 Small Cap Index down 5.1% for the month and up 0.7% for the year. And the Vanguard All World X United States Fund down 8.2% for the month, but still positive 2.1% for the year. 3-month Treasury rate at 3.7%, 2-year rate at 3.79%, and the 10-year rate at 4.3%. So we've seen yields move up a little bit over the past couple of weeks, Matt, obviously with concerns that inflation is going to reignite with oil prices spiking. I think something that you would expect given this environment.
Yeah, I think that's a good point to throw out there. My second item I want to throw out there is look at that Nasdaq composite return year to date of down 7.1%. I'm having PTSD or flashbacks to last March and April when the Nasdaq was dramatically underperforming the other stock indices. And if someone would have went to sleep at the end of March of last year and they woke up August 1st, they would have missed out on a tremendous run for the index. So I just want to throw it out there. If you're looking at that and people are really bearish on the Nasdaq right now being down 7%, you got to understand that that is an index that can move quick. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Yeah, which leads perfectly into my next point under our big headlines and current events from the past week. Nasdaq officially entered correction territory with the index more than 10% below its previous all-time high set in 2025. Again, maybe for newer listeners, correction by our industry is defined as a pullback of 10% or more from an all-time high. Bear market defined as a pullback of 20% or more from an all-time high. So yes, we have entered correction territory, and I think it's important to point out again, usually on average, if you look at data that we have from the stock market since its inception, we usually get at least one 10% pullback in the major indices per year. So it's not uncommon.
That's normal.
It's normal.
That's normal.
President Trump announced that the U.S. agreed to delay bombing Iran's energy infrastructure until April 6th to allow time for the countries to reach a deal and reopen the Strait of Hormuz, I think I'm saying that correctly, so that normal transportation of energy could continue. Obviously, last night, Matt, we got an address from the president. Sounds like things are going to continue over there for the next couple of weeks, depending on a couple of things. Markets rebounded the past 2 days or 3 days to start this week. And then I think this morning the market's not open yet, but futures are down after that address last night.
Yeah, it's interesting. I got several pieces. This week prepping for the podcast was challenging for me. And it was challenging because I had such a large amount of data that I could have shared on this podcast. And whenever I get in these moments where the data is so immense, we tend to be at a market extreme, either to the upside or the downside. Well, it's no secret right now that we're in one of those extremes on the downside. And in a second here, this is the perfect transition. I want people to temporarily separate themselves from the geopolitical headlines in a bit. And I'm going to go over just some data. And if we were looking at the data outside of the geopolitical headlines, the market seems very compelling and attractive to me right now. And obviously you have to overlay that all it takes is one tweet, one government update, stance, policy change. It obviously is going to dictate where this market's going over the next couple of weeks. But we just got to remember, most people in this market don't really care. They shouldn't care what the market's going to do over the next week or two. And as you look forward looking, some of the stats I'm going to share today are compelling, and I ask people to look through that longer term lens.
Yeah, well said. Moving on to tweets, articles, and research from this past week. The first thing I had was a post on X from the chart report. So Jenna will throw this up on the YouTube video. It'll also be in our show notes. But essentially what this is, it's a chart of the S&P 500 on top, and then below is the CBOE, Chicago Boards of Options Exchange 1 month implied in correlation index. And what they said is, when correlation rises, stocks fall. Are we getting close to a bottom? Question mark. Read the full note in today's morning print. So I don't think it's any secret, Matt, that when we get into some volatile times and extreme weakness for stocks, correlations go to 1. And what does that mean? Most stocks are all falling at the same time, right? And typically when we get that for a prolonged period of time, the chart report here is showing that we tend to be getting closer and closer to a market bottom. So examples of where the correlation index is right now in previous instances, going all the way back to 2023, have done a pretty good job of marking bottoms. Not saying we're there yet, but once we see those increased correlations of most stocks in the market falling, maybe outside of the energy sector, in this instance over the past couple of weeks, could be a sign that we're getting closer.
I'll say it a different way. When you see data like this, it's telling us that we are in the vicinity of a market bottom when you look at the data in regards to history. And that's important because could we see prolonged weakness the next month? Yes. But remember, most people in the market have a longer term time horizon. And when you start to see this data mount up, like I kind of insinuated a couple of minutes ago, then I hear this piece, which I did not see. It just adds to the narrative that I would be careful if I were an individual betting on a lot deeper correction that's going to be prolonged. Is it a possible outcome? Yes, because the market's pricing that in. But when you look at the lens of history, I can show you some pretty unsettling headlines, and the market recovered from it relatively quickly. So be careful using the term. It's different this time.
Yep. Second thing I had was a post on X from JC Peretz on March 27th. So again, Jenna will throw this up on the YouTube page. It'll be in our show notes. It's a chart of the large cap technology ETF, ticker symbol XLK in black. And then in blue is the Nasdaq 100 ETF, ticker symbol QQQ. JC says both large cap tech and the Nasdaq 100 are stuck below overhead supply. So what he is showing here is kind of a rounded top formation forming, and where there used to be demand for buyers stepping in, there is more sellers than buyers at that point. And, this is one of the reasons why I love charts and price so much, is that you can look at a stock chart and it can tell you almost everything you need to know about it, right? Mm-hmm. And as you can see for XLK, the large cap technology ETF, back in November of last year, and then in January, early February this year, at these levels, we saw buyers step in. And that was a positive thing, and we're not seeing that anymore. So like you said, I agree with you. Technology looks very attractive, especially from a valuation standpoint. Mm-hmm. But like you said also, or alluded to, just because it looks and feels and is attractive, that doesn't mean price has to turn around
instantly
now, right? It could be another month of weakness. So I think this is just something to be aware of, that previously where we've seen buyers step in, we're not seeing that right now. And again, this is a part of, I would say, the initial phase of the bottoming process, because, when indexes are breaking down and everyone's talking about it, it's like, okay, this weakness has been going on for some time now. And in this instance, it's really been since the fall for technology in general. Since November, it hasn't been very strong. So while one could look at this chart and say, hey, we're breaking down, another one could look at this chart and say, yeah, but we could pop right back above these levels and get more buyers stepping in, and then you could have a rip your face off rally to the upside. So I'd let people make their own decisions while looking at this chart, but at least right now, the path of, I think, least resistance is lower until we, kind of reclaim these important levels.
No, I don't disagree on a shorter term basis. The thing I'll throw out there, anytime that you see a risk off environment in the market, people are going to sell from the most highly liquid names to get the best price. And let's face reality, these Magnificent Seven, a lot of the top holdings of the QQQ or Nasdaq 100 are highly liquid when you compare them to a lot of other stocks in the market. And they're usually the first to be sold and the first to be bought. And I think it's going to be interesting. They might be underperforming relative to the index, a lot of these highly liquid names, to the downside right now. If and when you see that market turn, they should disproportionately outperform to the upside with what I just mentioned.
Yeah, well said. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So the first piece I have just has to do with option volumes, but more specifically, Mark, put volumes. And I'll get to that in a second. This post is from Subutrade on March 29th to put a timestamp on this. And Subutrade was highlighting that the put volume spiked on Friday. And previous spikes came close to market bottoms for the S&P. And again, the term close didn't just bottom tick where the market was at. So let's take a step back. We have, newer listeners all the time to the podcast. Put options are a straightforward contract that give you the right but not the obligation to sell a stock or an index like the S&P 500 or the SPY that tracks the S&P 500 index at a predetermined strike price by a specific expiration date. If the market falls below that strike price, the put can rise in value, making them a popular tool for insurance against declines or for straightforward bets on falling prices. Now, they tend to get bought heavily right around major market reversals, especially bottoms. And why? Because fear and uncertainty peak. Investors panic after a sell-off and rush to buy puts to protect their portfolios or to even bet on additional downside. This surge in put buying often signals the point of maximum pessimism and capitulation, where selling pressure finally exhausts itself. Similar wavelength, Mark, to what you were mentioning a couple minutes ago. So the market frequently reverses higher soon afterward. As the chart that Jen is going to input to our YouTube viewers, this will be in our show notes, it illustrates that extreme put buying tends to act as a fear thermometer that tends to flash, hey, the market's near a bottom. When you look at the data set, again, the reason I'm highlighting this, Mark, is when you see such dramatic levels of hedging on these put purchases, 1 month later on average when these events have occurred, the market was up 8% 1 month later, 12% 2 months later, 15% 3 months later. And the data sets on this was pretty interesting. September of 2022, March of 2023, and then all the tariff turmoil from last year, Mark. April 3rd of last year, April 4th, April 8th, April 10th. And then the last data set, besides right now, was November of last year during the tech sell-off when everyone was concerned about where we were with the AI trade. Again, it's a data point that says to me, we're in the vicinity of a bottom on a shorter term basis. Does it mean it's going to turn instantly? No. Your comments.
Yeah, I think, once people realize and understand that we're in a short term short to intermediate term downtrend in the markets, it might sound counterintuitive, but this is the type of stuff you want to see. When put volume spikes, that means people are fearful and they're trying to hedge and protect their portfolio against any further weakness.
Yes.
And typically when you get a lot of people doing that, they tend to be a little too late, right? And we've seen this happen throughout history time and time again. So like you said, doesn't necessarily have to mark the bottom, but we're getting closer.
It's encouraging if you're a long-term investor and you're optimistic. So number 2, I got to be careful. This can quickly turn into my rant of the day. When I go over this is the stuff that just gets me worked up in the market. But I told myself I would do the best I could to behave today. So here we go. So the first piece I see is from March 28th. This is from the Rock Trading Group. And they posted a chart of the S&P technology sector on their earnings or their valuation versus the S&P 500 as a whole. And the Rock Trading Group, Mark said on March 28th, the MAGs, that's the Magnificent Seven, the MAGs are now 2020 COVID cheap. There still could be a chance market heads lower next week, but earnings season is coming up. Could one heck of a rally when things bottom out. What this chart now is indicating, and Jenna's going to put this up for our YouTube viewers, this will be in our show notes, is the forward price to earnings valuation, the premium above the S&P 500 index itself, just for the technology sector. So for newer listeners, when you slice and dice the stock market by sector, that's things like technology, financials, consumer staples, energy, utilities. Go down the list of the sectors. Technology is the largest sector by market capitalization. And you would know better than me, 35%, 34% of the index-ish?
Well, yeah, I would say this fall it might be a little lower now.
Okay, 33 maybe?
Yeah.
Okay. So the reason historically technology sector has carried a higher valuation is that it has a higher growth rate on its earnings. Well, what is this chart indicating right now? With this recent correction, tech stocks on average are being valued from an earnings perspective just as much as the average stock in the S&P 500. Now, why does this get to me? Okay. There's a post I saw by Simplifying Stocks CPA. This was posted, Mark, on March 29th. And in this post, he has a couple of charts, which I'll get to, but I'm going to start by reading a specific quote from this post. Quote, the group as a whole, he's talking about the MAG 7, the MAG 7 as a whole has fallen 15% year to date and roughly 20% from its highs, meaning it's almost in a full-blown bear market. Let's pause. Will you explain to people what the MAG 7 is?
Yeah. So, and again, this is not a recommendation for or against any of these names. MAG 7 contains Apple, Amazon, Google, Meta, Tesla, Netflix.
You say NVIDIA?
Microsoft.
Microsoft, okay.
Yeah.
You got it.
Yeah.
So the MAG 7 as a whole down 15% year to date, roughly 20% down from its highs, meaning it's almost in a full-blown bear market. I'll continue. Now, while prices have fallen, the multiples on these names have contracted even more, meaning the valuation of what you're paying, they become cheaper. And that's because earnings growth hasn't stalled, the post said. In fact, it's accelerating. As a result, the group, excluding Tesla, the MAG 7, now trades at a 21.5 times PE. S&P 500 earnings growth estimates for the second quarter of this year, the third quarter of this year, and the fourth quarter of this year have also been on the rise the past 6 weeks. And the bulk of this strength is coming from the Magnificent Seven. I'll continue. Jen's going to put up this chart that was listed in this post. And what it does, Mark, is it shows the year-over-year earnings growth of the Magnificent Seven group, and then it shows the remaining, it says 493 stocks. You know it's technically 503. Okay. So if you look at this, let's just take a look at 2025, the forecast. Magnificent Seven, on average, is expected to exhibit 21% earnings growth over the previous year. The index itself, the other stocks in the index, 9% on average. If we go back to last year in 2024, the average, is going to be posted at, in 24, 40% for the Mag 7, 4% for just the S&P. So now let's look at 26. 26 this year forecasted to be 24% for the Mag 7 and 12% for the index. Now, wait a minute. The next piece I want to talk about that he posted is these earnings estimates. When you look at Q2, Q3, and Q4, all these headlines we've had over the past 4 to 6 weeks, you'd think with the way stocks are trading, the earnings outlook can't be good. But this data is from Bloomberg. Analysts who track these companies have been raising, ever since this geopolitical tension began, the earnings estimates for the S&P. So wait a minute here. You have a difference between what's showing up in the price of these stocks going down, geopolitical headlines, uncertainty, what's this going to turn into? And underneath the surface for the fundamentals, you have actually earnings estimates going up. You now have tech stocks on average that are being valued at the same rate as the rank and file stock in the S&P index. However, the earnings growth on those tech stocks is dramatically more than the average stock. So where does this lead us? We're in an environment right now where tech stocks have been the ATM. They have been the selling pressure that's been the easy way to de-risk and have a lighter risk footprint. And I'm just arguing that once you have some clarity, whether it's a day or a month, and these earnings estimates are hanging in there, that could be a compelling place where you see the rally start. Your thoughts?
Yeah, I don't have much to add. I think you hit the nail on the head. It's not often, I would say, that we see these types of technology names trade at these cheap relative valuations. So if you are that person who has said, I'm waiting for a fat pitch, I'm waiting for a perfect opportunity to invest, not telling you to do anything or to not do anything, but if you look back at history, times like these have shown that
in a longer-term perspective, they tend to be attractive.
Yeah.
My last piece, we've talked about this many times in the podcast. This would be beneficial for our newer listeners. Just a reminder about these midterm election years. They're the most volatile, the 4-year presidential election cycle itself. I posted this on my own X page, March 28th. And it's reposting something from another individual that shows the max drawdowns in these midterm election years going back to 1950, and then the average return, the actual return 1 year later from the bottom. And this is what I posted. I said, midterm election years are the most volatile of the 4-year presidential election cycle. Good data indicating the forward returns after the max drawdown in each of those years. The average drawdown is about 15-16% mark, and the average recovery off that low is a little bit shy of 40%. Does it mean it's going to work out exactly that way? No. But just be careful in these midterm election years. They're volatile on the downside, but so is the recovery.
Yeah, and the only thing I'll add to that is, I've been talking to clients here and there, and I keep telling them, I'm like, listen, just because the market's been weak to start the year does not mean the entire year has to be weak. Let's just look back at last year.
Yeah, sure.
Markets were down almost 20%, and then they finished up almost 20%. So it's not a situation that just because the first quarter was horrible doesn't mean the rest of the year has to be. Now, a weaker start doesn't bode well when we look back at history. And like you said, we are in a midterm year, but it's not out of the question.
No, I mean, go back to last year, because I think it is an important analogy because the proximity is so close. If you were a listener of our podcast at the time, we were giving the other side of the coin. We were the minority in the market last March and April. And if all of a sudden you go out to June, July, everyone's talking about, oh yeah, it was a great a buying opportunity. Of course we were talking about that. Hogwash.
Yeah.
Hogwash.
So moving on to the financial planning topic of the week. This was an article on March 13th from Tara Siegel Bernard with the New York Times titled, "His Father Lost His Life Savings in a Scam. A Fake Lawyer Offered to Help." So I think over the past couple of weeks, Matt, I've had more of a focus on cybersecurity, on fraud and scams and stuff, because we keep seeing this pop up more and more.
Yeah.
So I thought this was a good story to share just because we've heard of similar stories. So they say Nick Jonas, not the Nick Jonas you are thinking of, his father was ensnared into an elaborate romance scam.
I was thinking it, John.
Where cyber criminals took off with at least $1 million of his savings. Just a few months ago, a lawyer who claimed to work for the financial crimes arm of the U.S. Treasury reached out to Mr. Jonas's father with the type of news that every scam victim yearns to hear. Law enforcement was working on the case, and it might be able to recover his money. They set up a video conference with this person, but it turned out to be another scam with this man posing as a lawyer. This type of fraud is known as a recovery scam, common ruse used by cybercriminals who try to exploit the victim's desire not only to get their money back, but take advantage of them again.
Yep.
Scammers already know a lot about that particular victim's circumstances, and using that information can frame their pitch to that victim to make it more legitimate. Scott Norris, a special agent with the FBI, said, "We have seen a ton of law firms being impersonated, and we've even seen folks impersonate FBI agents and other federal law enforcement. Some criminal groups wait for victims to find them. Bogus recovery firms, often offering free consultations, advertise their services online. And when victims search for ways to recover their money, they'll sometimes show up at the top of their search results," which is pretty scary. So what should you do if you are in a situation like this to protect yourself? I would say, number one, report crimes to the FBI's Internet Crime Complaint Center. That's www.ic3.gov, or the Secret Services local field office can also help. That's closest to you.
Yeah, usually if you have a federal building in your county, like here in Montgomery County, there's a federal building where a lot of those entities have a physical presence.
Yeah. Know that the FBI will never ask for money, move communications to private messaging apps, or request bank account details or personal identifying information. If the FBI has identified you as a potential victim, representatives will reach out via email or phone, and agents who call by phone will voluntarily provide a way to verify their identity. But if you're still unsure, contact your local FBI field office, which can help confirm the agent's identity.
I'm a big fan. Anytime you get an incoming call, it's okay to write down that number, do searches on that number, look up the number that you think it should be yourself. So someone's calling you and saying, hey, they're from FBI XYZ office. Be like, okay, is it Mark? Okay, Mark, I'm going to look up the number for the FBI field office in Detroit. I will call you back.
Yeah.
Never just take that call and run with it.
Yeah. And where I think this tends to really hurt a lot of people is elderly
Absolutely.
victims, right? You've heard recently more of, with technology and voice impersonation and AI of, people calling people's grandparents and it's sounding like their grandkid needs help or needs money or needs to wire money.
Yes.
And they're out several thousands of dollars, sometimes hundreds of thousands or millions of dollars because of that. So you just have to be really, really careful. One thing that I think of is that when my younger brother Ryan was still in school at UD and he was working for us at the time, interning, someone texted him claiming to be you to go get gift cards.
And he was he relatively was new starting here.
Right. Mm-hmm. So it can happen to anybody, right? Yep. So and he said it actually kind of sounded like the way you talk, the way the text message came through, which is kind of scary.
Yes.
So just something to be aware of. Keep your eyes and ears open at all times.
I think it's a good piece to throw out there.
I mentioned this last time when I was on with Aaron before we hopped off. Earnings season's right around the corner. I think JP Morgan, Morgan Stanley, Wells Fargo, Bank of America report within the next 2 weeks. So going to be right back into it, and we'll see if those earnings turn out to be stronger than people think, and or if it takes kind of the attention from the Middle East back over to what actually drives stock prices, earnings.
Yeah, absolutely. I mean, my fortune teller aspect is no one knows if the conflict is going to go on for another day or another month. So I would avoid trying to speculate on that topic because you can't control it.
Yeah.
What I would recommend that you do is, if you are an investor, most of the group that we are talking to, our audience, is a longer term investor. I think that this is a time period where you want to look through the lens of opportunity that's out there. There's a lot of stuff that's on sale. And if you're a longer term investor, focus on those portfolio themes that you think will come back into play once the geopolitical noise subsides. And I will make an argument that as we get deeper into the end of April, and a lot of these companies are reporting earnings, that all of a sudden, if we get an off ramp on this conflict, it's going to bring the focus back to these fundamentals. I don't think the fundamentals are going to be that bad. In fact, I think they're going to be quite good. And all of a sudden, I think the narrative changes in the market.
Yeah.
We'll see if I'm right.
Yeah. Well said. Well said. Well, thanks everyone for listening to episode 344 of the Independent Advisors Podcast. Catch us next week for episode 345.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.